I'm still pleasantly surprised at how things are going, but I am now noticing strains in the economy from higher interest rates. You aren't seeing, as an example, in most markets, declining home prices, but what you're seeing is declining volumes, which is to say the sellers, well, some of the sellers are constrained because they can't sell because they have older, lower interest rate mortgages. Others have price expectations that the new buyers can't afford because of higher interest rates. So I think now that you're seeing what you and I talked about 6 or 7 months ago, which is the lagging impact of higher interest rates.
Rick Rule candidly unveils the shockwaves of higher interest rates on the economy, particularly noting strains in the real estate market as sellers grapple with constraints from older, lower interest rate mortgages. Despite acknowledging the U.S. economy's resilience, Rule anticipates a delayed impact from the reverberations of heightened interest rates, issuing a cautionary note on potential strains in the banking sector and the precarious nature of fictional financial statements. As Rule navigates the challenges posed by increased interest rates on equities and debt markets, he paints a vivid picture of a delayed economic reflection, emphasizing the systemic impact on budgets due to the repricing of the interest component on the massive $33 trillion federal debt. The crescendo of his discourse unveils a compelling perspective on gold prices, attributing potential spikes to a crisis of faith in maintaining purchasing power amidst rising interest rates. Let's watch the clip. Also, make sure to hit the like button, subscribe, and drop your comments below.
I am still very impressed with the strength of the U.S. economy. If you had told me, or rather because I'm noisy, I had told you 3 years ago that the economy could stand as leveraged as it is, a doubling of interest rates, I would have thought that one or the other of us was consuming a newly legalized product. I think we are in the delayed punch. Whether or not we could have a combination of one and two is a very different circumstance. If the economy does slow down enough that the Fed can engineer what the economy believes to be a soft landing, which is to say that they can bring about lower interest rates without an ugly recession, they will have done a very good job. I think, although I'm not a fan of the Fed, I think that given the job that the Fed has done in a complete absence of sanity from Congress is pretty remarkable. While I don't like them, and I don't like what it is they do for a living, I think they've done a remarkably good job. I think there's still strains in the U.S. banking industry. And I think that there are a lot of banks that have a lot of commercial real estate mortgages on their balance sheet that haven't yet been marked to market. The banks are allowed to publish fictional financial statements in the sense that if they suggest that their bond portfolio or their mortgage portfolio will be held to maturity, they don't have to mark their portfolio to market. There are lots of mortgages in bank balance sheets that are performing, but were written at lower interest rates, and were they priced as bonds, they'd be selling at 60. They're allowed to carry the bond at 100 because of the fiction that they're held to maturity. And I'm not sure that has shown up yet, and that gives me pause. Higher interest rates do two things that are difficult for equities and debt markets. They lower the capitalized values distributions. When the interest rate goes up, existing, lower paying obligations are priced at less. At the same time that they raise the cost of capital to institutions. And I don't think that that's been felt through the economy. The malaise that you're seeing in many equity markets and the wipeout that you've seen in the long-term debt market is yet to be reflected in the economy, but it's beginning to be reflected in the economy. I think, too, that what you're seeing in the United States is systemically higher budgets because the interest component on the federal debt is repricing. We're living today on money that we borrowed 2.5 years ago. When you pay 4.7% interest on that debt as opposed to 1.5% interest on that debt, and when the debt itself, the denominator is $33 trillion, it ends up being a very large number. And I think we're starting to see that right now. My experience, and I'm not a historian, I'm a loan shark. My experience has been that what gives you much higher gold prices is a lack of faith in the maintenance of purchasing power in conventionally denominated interest rates. I have seen people use war as an excuse to express their fears and buy gold. But my own experience has been that fears outside of the maintenance of purchasing power have been short-lived. So my suspicion, and I can't tell you why because I'm not a historian, my suspicion is that any elevation in the gold price is a consequence of world events, Middle East or the Ukraine, will be short-term. What will be longer-term is the expectation that U.S. inflation is higher for longer, and that if you store your purchasing power in bonds or certificates of deposit, that you're guaranteed a loss of purchasing power. That's what happened in the decade of the 1970s.
In this next segment, Rick Rule's insights on gold and oil promise a thrilling ride for investors. Delving into gold prices, Rule unveils a fascinating narrative, attributing any surge to global events and a historical lack of faith in traditional investments during interest rate hikes. It's a journey through economic nuances that challenge conventional wisdom. But the excitement doesn't stop there. Rule's crystal ball turns to oil, projecting inevitable price hikes not due to geopolitical tensions, but an unexpected culprit: political correctness. Governments proclaiming the end of oil by 2032 have inadvertently set the stage for a captivating drama. As the cost of capital soars and underinvestment plagues the industry, Rule sees leaders like Trudeau and Biden unintentionally becoming guarantors of prolonged elevated oil prices.
I think oil prices are inevitably higher, although perhaps not in the near term. I don't think that they're inevitably higher because of a lack of Middle East peace or a lack of Russian oil coming on the market. Russian oil by the market is coming onto the market anyway. It's just been retitled Indian oil. It's still there. What is going to keep the price of oil high is political correctness. It's the fact that the big thinkers of the world, the big governments of the world, have told us that oil is going to end in 2032. They've raised the cost of capital of oils. The oil industry as a whole, including state-controlled oil companies, are underinvesting in sustaining capital as to $1 billion a day, over $360 billion a year. If you don't invest today, it impairs your ability to produce a year and a half or 2 years out. So ironically, the best guarantor that we have of higher oil prices is Prime Minister Trudeau and President Biden. Not what they intended to do, but the consequence of their action is that oil prices are higher for longer. Well, I think longer term, it will impact oil. The peace that we've seen over the last 4 decades, increasing globalization, the lack of need for countries to secure their own geopolitically secure supply chains, those are gone. And you're beginning to see a scramble for resources by societies. The Chinese, as an example, have restricted access to the West to various rare earths and small commodities. What that means is that we'll have to look for non-Chinese sources. At the same time, we've tried to exert our influence against the Russians, as an example, by putting an embargo, as silly as it is, on their oil. There is a geopolitical shift. What we're seeing now is various countries doing what the Japanese had to do in the 1970s to secure access to supplies, what the Chinese did in the decade 2000 to 2010. Other societies will have to do that now, Middle Eastern societies, the Indian societies. You'll see continued competition among societies to secure access to geopolitically strategic resources in a broad variety. And people who pay attention to trends in that sense will have a lot of investable themes and resources.
So let's recap what Rick Rule said. We've uncovered invaluable insights into the current economic landscape, exploring the repercussions of higher interest rates on real estate, the banking industry, and the broader economy. Rule's keen observations reveal the delicate balance between market dynamics and government actions, shedding light on potential future trends. From the intriguing dynamics influencing gold prices to the unexpected factors shaping the future of oil, Rule has unraveled a tapestry of financial foresight. As we navigate the intricacies of global markets, it's clear that investors need to stay vigilant and attuned to the evolving geopolitical landscape. Don't miss out on the next big moves. Subscribe, stay informed, and empower your financial journey.